On a recent getaway, I was asked about some of the markets that I trade. Most are pretty straightforward, but I want to give you some insight about trading currencies. I started my trading business in the currency markets, and I'm still active in that market. I trade it a little differently now than when I started out, though. Now, first off, the cash market, it has no central exchange, but it's a combination of brokers, banks, corporations, and individuals like you and I. For most retail Forex traders, your broker is actually the market maker. They're the ones that provide the liquidity behind your trade, so you should ask yourself if their interest is really for you to win or lose. Now, the good thing about market makers is you really have no issue getting filled at any price point. On the other side of the coin, the currency futures trades on an exchange, so you can expect transparency in the dealings. Strict regulations are also in place, and that goes a long way in protecting your interests as you trade. Retail traders pay a spread, which can range, depending on your broker and the volatility, 1 to 7 pips, although the higher end is reserved mainly for the exotic pairs. Now, those that trade in the futures market, they pay a commission, and all fees usually end up less than $5 a round turn. So let's do a quick comparison. Imagine you're trading the Euro USD through a retail broker, and 1 standard lot is what you trade. A modest 1 pip spread will cost you $10 just to enter that trade. So you need to get 2 pips in your favor to make any money. Now you take the same euro and you trade it in your futures account. Now I'm going to be liberal in the commissions, and I'm going to charge you $5 to take the trade. Well, wait a second here. Each point in the futures is $12.50 per contract. So with 1 point in your direction, you're already in the money. So do you see where I'm going with this? It makes a lot more sense from several angles to take my day trades in the futures market. The volume is good, and the slippage, I find anyway, is pretty rare. But here's where it gets interesting. Day trading is income producing, and it's a really hands-on activity. Swing trading, though, can be considered wealth producing, and it can be a little less time consuming. The issue is when you hold overnight in the futures market, you now have overnight margins to contend with. That's not an issue by itself, however, but what if I want to trade a market in another time zone? Holding a position also affects what I have available for the day trading side of the business. So what do? I would take my swing trades in the retail market. But wait a second, didn't I just say there was an issue with the cost? There is. But the difference is that swing trades go for a much bigger piece of the pie than the day trades do. So the higher cost of doing business is offset, at least for me, by looking for much bigger moves in the market. Now I can justify the expense, which is the spread cost, given the advantage I get with swing trades as well as keeping the day trading margin open. Now this works well for me, and it's something that I'm going to continue to do. While there are still games, with the brokers and Forex, I'm really not as vulnerable to the spikes in price when I swing trade. So I hope this opened your eyes to different ways to run your trading business, and give it a shot.